First rates on your screen, any second now, will just start coming up. And the first rates on your screen are, well, we can go to the market screen. We don't have to show the space right now on the moon surface. For the markets right now, it's 1914. It's 18 point up for the Nifty. It is the market breadth which is looking strong and powerful today. And then you've got Adani, Apollo Hospitals, Infosys, all these stocks are off to a good start. So if you look at the market setup right now, it's a good start. Advanced decline ratio favorable. It is picking up pretty much what it lost yesterday. And I think the Bank Nifty also is off to a decent start.
Okay, just want to look at some of the individual ideas as well and show you how they're currently performing. So let's revisit BHEL, the big high flyer from yesterday. CG Consumer as well, they're embarking on a 2.0 journey with a focus to drive double-digit revenue growth. So that's CG Consumer, 2.5% higher. Cipla as well as Torrent Pharma. It seems that Torrent Pharma has now joined fray for Hamid family's stake in Cipla. That is what the Economic Times reports seem to be indicating this morning. Torrent Pharma up 1%. Let's see what Cipla as well is up to. And that stock will just come up for you on your screens. 2.6%. A solid move on Cipla. 1250 plus is where that stock is right now. By the way, since we're counting down to Chandrayaan 3's soft landing on the moon, it's L&T, MapMy India, Nelco. These are the stocks or companies which have had some contribution to India's moon mission. So these are the stocks which are actually in focus. MapMy India, of course, has been quite the performer in the last 6 months or so. Another 0.5% of a bump up coming in for this stock. By the way, Tata Motors, JP Morgan is maintaining its neutral stance with the target price of 635. They're saying discount rates in China have moved higher for OEMs, including JLR. So that's not all that positive news. According to them, the stock, though, is pretty muted in trade, 621 thereabouts. And Apollo Tyres, UBS has downgraded the stock from the earlier buy to now neutral, and they've cut the target price as well to 430. That's Apollo Tyres in trade for you. 393 is where that stock is currently in trade. Besides that, there's rights. It's order, it's bagged an order for the defense from the Defense Ministry. Linde India as well received an LOA from IOCL to set up an air separation unit. So these are a couple of these small names which are in focus. And yes, ONGC and Oil India, Brent is lower. Remember, WTI crude has now slipped below $80 to a barrel. So these are the two stocks which are in focus. By the way, Brightcom, we've been reporting this particular stock to you. SEBI has barred the CMD as well as the CFO from holding KMPs in the listed company and many other market entities as well. That stock surely has gapped down this morning, 5% lower on Brightcom as we speak right now, Nikunj.
Okay, let's get the first rates going from Kunal. Kunal, it's a good start. Looks like yesterday's weakness could get challenged.
I think it's a flat start for the index, for the Nifty and the Bank Nifty. But again, the action is more stock specific. Mid-cap index making a fresh high for itself. So I'll stick to a few mid-cap names. NMDC is something which looks attractive on the charts. The stock gave a price volume breakout yesterday. In fact, 2 days of consecutive momentum for NMDC. So that's a stock which I'll look to trade in the open.
Vaishali, what are the first trades that you're punching in?
So, well, NMDC was the stock that I already recommended, and so I continue to stay bullish. And now I would also look at Hindalco, because Hindalco is showing some signs of improvement from its support level. So I think it is ready for a target of 470 to 480.
Kumar Jain joins us now. Let's take a conversation forward. Let's understand that how currently CLSA is mapping the risk-reward ratio, and after this gangbuster rally, is there more steam left? Good morning, Vikash. How are things?
Not bad. Thanks for having me, Nikunj.
So what is your advice to two category of clients? A first-timer who's missed the rally completely. Why would anybody miss it? But there are folks who miss the rally. What is your advice to the first category? And what is your advice to the second one who's participated in the rally? That is it time to stay put or take some profits off the table?
Well, I think it's what has been good is the rally has now given us some breathing space. So we have this proprietary kind of sentiment indicator called India Bull Bear Index. It has worked very well. It kind of around the lows of March gave us a point where everybody was very bearish and we became quite positive on the market. And sometime in the middle of July, it kind of turned pretty extreme. And that's when we started trimming risk. Now, once it goes to one extreme of being super bullish in terms of sentiment, we do not know how that sentiment will adjust itself back to a more acceptable level. That can either happen by a sharp pullback in the market, or it can also happen like it seems to be happening this time by sideways kind of small pullback and a long duration where the gains are getting digested. So, I think it's one of those things. We are in a world where, there is, honestly, it things can turn either ways. It depends on how the market looks at data. Because more or less, we are getting to the end of the hiking cycle. That's more or less is something which the market needs to get convinced about. I think the upcoming Jackson Hole speech, as well as the next the Fed meeting in September, should maybe convince the market that most of the hikes are now in the back, and there are unlikely to be more hikes. Once that is done, then is this does data really worsen, or does it keep on kind of showing that we are not slowing down globally in a very material fashion? If that is the case, then I think markets are likely to take the thing, take the situation as the glass half full, and perhaps we could have a further surprise rally. If that is not the case, and commonsensically speaking, Fed is trying to unravel excesses of over a decade. It's tough to imagine that can happen without things getting broken. But so far we do not see anything major which has got broken. If the market starts getting worried on that side, then that is where we could have a deeper correction. It's really the two of them. A gun to my head, I think both will happen, but it's just the order in which it might happen. Markets might initially get more okay, that growth is pretty much controllable. It's not really slowing down materially. And later, there could be disappointment on that. So, I mean, in the interim, we could have a broader participation of the rally. So, that's how I think it could play out. But this is a very tough one to call. So clearly, one needs to have a kind of one of the hand on the exit door, even when they want to kind of keep on participating in this rally.
So where is it that you're feeling valuation discomfort? Given that in your recent note, you've highlighted that the recommended downgrades exceed the upgrades, even though the earnings estimates were lifted.
Yeah, that's a very interesting thing which has happened in the last quarter, that it was firstly a good quarter when it came to earnings. Not only what results were reported on the first during the quarter, because I mean, no matter how I slice and dice it, overall universe, even adjusted for oil marketing companies which had pretty big moves on a YY basis, earnings came out to be pretty resilient and stronger than expectation. But however, this is largely happening in the midst of that July rally that we were seeing, and it appears that analysts were somehow feeling like a lot of this is in the price. And our analysts, surprisingly, we had of over well over 100 stocks that we kind of prepared results for. Almost 14 companies were downgraded and only 2 were upgraded. That's a pretty big chunk that we are talking about. That's over 12-13% of the stocks getting downgraded during the result season. This is despite the fact that this was the first quarter where, after 5 or 6 continuous quarters, where during the earnings season, we saw consensus downgrading numbers. This time, consensus ended up upgrading numbers. So there was possibly some kind of discomfort that the incremental upsides do not look large enough for for analysts to kind of continue thumping the table on big buys. I think on that count as well, a little bit of a breather, which we've been having for the last 4 or 5 weeks on the large cap side of things, clearly should be, kind of helping everybody think through all of this. Because there are 2 ways to look at valuation. Now, this is what the analysts did on a bottom-up basis. On the top-down basis, see, we are not really, I would say we are not ultra stretched. I mean, it's not eye popping. However, we are not super comfortable as well. So if you were to look at things like where our PE is, it's now gone below one standard deviation to historical average. If I were to look at even simple bond and earnings, bond and equity valuation relative basis, even that seems to have kind of, become a bit more, it still has some room before it gets into the danger zone. So I would say it's manageably stretched on a top-down basis, but there are pockets which one needs to be more careful about. So that's how it's going to be a more stock picking kind of a market.
Okay. So let's start looking at large pockets here. And if one looks at the banks, even though it's turning out to be a good year for equities in general, both locally and globally, banks have just hugged on to the flat line. Good numbers, consensus bullish view, growth is there, and the outlook is also decent. And flows are also good on a net basis. But the sector of choice has become the real laggard in last couple of weeks. Why is that?
Yeah, I mean, that's a pretty relevant question, Nikunj. So I think what has happened was over the last few months, I mean, RBI's last hike was somewhere around February, if I remember correctly. Then the April meeting gave a sense that are we getting closer to a cut? And that's when we saw yields also cooling off. Now, I think the narrative on that could start changing, in the coming weeks. And if you were to even look at today, we have, in the on the monthly economic report that has come out, there is some sense of being more careful because of inflation. I think my personal opinion is that we are in a longish pause and a rate cut may not be imminent. I think the market has not taken an opinion on that. And if market concedes and agrees to my opinion, then suddenly the nervousness on banks will also come down, because if we get into a rate cutting cycle, then that's where you get a bit more nervous and saying that, names could contract more aggressively. But if we are in a longish pause, then the impact could be more manageable, given that right now there are no asset quality worries in any significant way. So I would say that around February, March, people started, getting more convinced that we are getting closer to a rate cut. I think there is a little bit more equivocal debate around that on whether there is going to be a rate cut soon or not. Soon, I think perhaps we will move to a situation where markets will start believing that this will be a long duration pause. If that is the case, I think banks will be back in flavor. And that's why in the India focused portfolio that we run, we have banks as one of the key overweights other than energy.
Because when you speak to your clients, some of your peers and some of your counterparts, what is the sense you're getting in terms of the liquidity outlook? Because, time and again, we go back to that same comparison, India versus China, China versus India. China was attractive, China will be attractive, and China will remain attractive. India was expensive, India is expensive, but will remain expensive. Then why do we debate this? Because this is history and this is future.
Sure. So, Nikunj, I think the reason is that China is still a pretty big market. And I think the debate is obviously that will China be able to do something more meaningful to be able to attract, to be able to kind of change sentiment over there. Sentiment towards India and compared to what sentiment is towards China, it can't be more divergent. I mean, people seem to have completely given up on China. On the other hand, sentiment towards India is super positive. But that is also in a way reflected in valuations. I mean, China is very, very attractive on a valuation basis, but that is versus history. And a lot of people argue that that's not relevant. So something I think and we've had, I think this will be the fifth or sixth month of continuous positive flows from foreigners. And what has been very encouraging, particularly for the month of July that we looked at, that a significant proportion of flows that came into India were through India dedicated funds. So in fact, India dedicated foreign funds make up only 6% of the total FII AUM. However, they contributed 40% of the FII inflow that came into India during the month of July. If sentiment towards China doesn't change, we are now seeing money coming not through the EM basket. Now imagine 94% of the FII AUM still is not India dedicated. That's either EM or some global fund, etc. So there's not really investors putting directly money into India. That could start changing. And that, I think, anyways, is the longer term story. Has that started happening? Is the question. But clearly, I think what's difficult to predict is what will be the, Chinese policymakers, what will they be doing? And I think all eyes will be around the time when rains are over, that is in the last quarter of this year, if there is something more significant as a stimulus. Because if that happens, then even the color of stocks which start doing well in India will change. And perhaps India will not outperform if there is a more believable and large stimulus, even though it might have absolute upside still for India. But we need to be careful. If that happens, then a lot of the stocks that are currently not being doing well, like things in the commodity space in India, could start doing much better. So I think that's really going to be a crucial thing to watch out for, even from a global perspective, and will also have an impact on sentiment on India on a relative basis. So, maybe sometime around October, November is when we should be looking at that more closely.
Morning. What about the outlook when it comes to the rural theme? Do you believe that it has already played out, or that there is still a lot more promise when it comes to rural stocks, especially when it comes to their financial metrics?
See, I think at this point of time, we still do not have conclusive evidence. We've had some positive commentary by companies in certain pockets here and there, but nothing positive in the sense encouraging, I would say. But nothing very conclusive that says that rural, as a theme is back and is kind of now improving. Now, I do hear a lot of people drawing a parallel that going into the election period, typically rural should do well. However, what I would, want to also nuance that by is that, yes, I mean, historically that might have been the case. But if you were to look at earlier governments, none of them in the more recent past have been so supply side focused in their policy making. There's been very limited demand side measures that the government has done. Even the recent budget did not have a lot of direct demand side measures. So is this election period going to be similar like other election periods and could have short-term relief for rural? That's something which I would not want to simply draw a parallel to earlier election periods, given this difference, which is a clear, important nuance to focus on. So I would say, I still do not have any conclusive evidence to kind of give you an answer either ways on that one.
Far are we away from a real bounce in IT? The world is divided on old business, new business. What is your understanding?
Yeah, I think so. IT and banks is clearly the two things that you need to get your calls right. Otherwise, it's very tough to outperform. Luckily, we've been a bit lucky in getting that call right over the last 2.5, 3 years. That's why our India focused portfolio has done pretty well. I would say I am still in the camp that the recent recovery that IT stocks have seen will have now again taken their valuations to levels which are not very attractive as compared to that. The other large sector, which is banks, is something where valuations are in general attractive compared to that sector. So within the two, I still prefer banks. For IT, I believe, it's just a long derating period, which started with early 2022. And just to kind of remind you, at that point of time when valuations went to +3 standard deviation to historical average, that was a point when everybody thought that this sector has changed forever after COVID because technology has become so important, etc., etc. And when something becomes so expensive one way, the derating period can also be, particularly when we have very good quality stocks, they don't really collapse in a matter of months. The derating period generally is longer, which involves correction of multiples. Yes, a few of them have become a little bit better in terms of valuation, but the sector in general, I think, is still not attractive from a simple valuations perspective.
All right, good to have you. Thanks very much, Vikash, for sharing with us your outlook on the markets, individual themes as well that look promising. Okay, what's up with the markets? Well, pretty much nothing. It continues to remain a very flattish move on the index. And yet again, surprise, surprise, or rather none, given the fact that the broader markets are continuing to scale up. At least that outperformance is evident day after day. SCI up and away, MMTC looking strong, CG Consumer, Linde India, Thyrocare, as well as something like BEML. They're all abuzz in today's trading session. But let's put the spotlight then on Bharat Forge as ET Now on the go meets CEO at work. It's a very special edition. At their Pune plant, Amit Kalyani lays out the growth roadmap for the company and talks about their short and long-term plans, shedding light on how the new businesses are performing.
Well, one mega trend which is clearly emerging post-COVID is that India is now emerging as the port of call for manufacturing. So the renaissance period for Indian manufacturing sector has started. And one company which is really going to be occupying the front seat there is Bharat Forge. From an component maker now to becoming a world-class technology product manufacturing. Now the company in past couple of years has gone through twists and turns of global volatility. So the what's behind Bharat Forge in terms of diversification, what are the plans and how are they looking at encashing EV, which is electric vehicle, that big capex there, and defense, where they already have a sizable presence. Let's take that conversation forward in this new show of CEO at Work with none other than Amit Kalyani of Bharat Forge. So nice to have you on ET Now. Thank you for joining us.
Thank you for me.
Post-COVID, India has emerged as the go-to destination, and many would say the renaissance period for Indian manufacturing sector just about started. Is this hope or hype, or this is reality?
So I think it's a reality for several reasons. One is that manufacturing in Europe has become very expensive. China has had its own set of problems, whether it has to do with the whole response to COVID and the way the lockdowns affected manufacturing and shipment from China, to issues that countries are having with China. So everybody wants to de-risk themselves from China, because if China were to stop exporting to you tomorrow, what would happen? People are comfortable with India. People have built long relationships and have good experience of working with India in the IT space. Indian people and Indian capability is well respected. And Indian manufacturing has also made its mark in various fields. And I think people see India and its whole population pyramid, its entrepreneurism, its education, its skilled manpower as one of the biggest untapped opportunities to grow Indian manufacturing and global manufacturing.
The traditional argument has been that India is not competitive enough. They cannot be a reliable partner. And that is something which has hurt us, whether it comes to textiles. And with the exception of autos and some specialized companies like Bharat Forge, the number of success stories are very limited. Why is that?
So, in India, I think things happen because an entrepreneur takes an exceptional effort in making something happen. We don't have a cohesive policy that really supports a sector. In China, you have whole towns which are built around one industry. I mean, it could be from furniture to toys to electronics to whatever. Now I feel the whole PLI movement is in a way negating that disadvantage we have and putting some winds behind our sails. So if you take entrepreneurism, if you take availability of technology, you take digital technology and digital manufacturing, PLI, plus the fact that the West has lost its competitive advantage, not just competitive advantage, but the will to manufacture, because they don't have people who want to get into manufacturing. A lot of people have gone out of the workplace or out of the workforce post-COVID. So all these have led to this vacuum being created, which I think India can take up very quickly. The second factor is that India is going to be a big driver of global growth and global demand. You know, I often used to say that China has built infrastructure for their grandchildren and we are still building for our grandparents. I mean, our cities are underdeveloped from any point of view, and India needs to urbanize at a pace which, you know, we have never seen. And if that has to happen, we have to build huge amount of infrastructure. And for building all that infrastructure, Make in India is going to be the way forward. So if you put all those pieces of the puzzle together, Indian manufacturing is going to grow from 15-16% to 25% of our GDP, and a GDP which will be by 2030 at least double of what it is now.
So the operating leverage for the defense business, when will it kick in on the aggregate balance sheet?
So you will start seeing that by Q4, but honestly the real, I think this year will be the year of big growth, but the real growth will come next year as well.
So we are at your R&D center. I'm being told that we would be entering what, you know, my son says the Tony Stark kind of a workshop, all excitement, all gadgets, all equipment. So what is the space where you're entering?
So this is the Kalyani Center for Technology and Innovation.
Okay.
So we have two centers here. The Kalyani Center, so that is the Kalyani Center for Technology and Innovation. This is the Kalyani Center for Manufacturing Innovation. So technology innovation focuses on fundamental technology, material development, material testing, and stuff like that. Whereas here we actually take the technologies that we develop there, the knowledge we develop, and convert it into products. So here we have everything from jet engines which we test, which we have made ourselves, to making gearboxes for helicopters, to making extremely advanced drones, unmanned aerial vehicles, unmanned ground vehicles, electric vehicles, things for defense that are behind those screens which we can't show you, and so on and so forth.
Chale, we look forward to see that. Mr. Kalyani, what is this?
So this is an unmanned ground vehicle that we built.
Okay.
It is electric plus engine operated. So the engine can charge the battery. So it can work in fully silent mode, or it can use the engine to charge the battery and increase the range. And it is fully amphibious, so it can even go through water.
Wow.
So basically we built this for patrolling sensitive facilities. Like during Pulwama, how people infiltrated our base and attacked. You can put a remote control weapon station on this. You can put a tranquilizer gun on it. You can do anything you want with it. And these can work as a swarm. So there are 2-3 of them that can work together to pin people. You can work with the small one and the big one together. So this thing is a 6x6. This one is a 4x4. This has a hybrid electric drive, which means it has a engine and a battery, but the drive is by electric motor, so it can run in fully silent mode. It can go up to about 20 kilometers an hour, and it can climb 30 degrees. It's got silent capability of about 6 to 8 hours and almost 12 hours in hybrid mode. And it can go through water as well. It runs off of remote control. It has a large range, some 8-10 kilometers, and it's got a full IR sensor and camera on top, so you can see in day and night, plus you can do thermal imaging. And if you were to mount any kind of payload on it, you can even put a stretcher on it if you want to, you know, bring someone who's injured or whatever. You can carry some cargo. You can, it's a multi-purpose use vehicle. Basically, where you have to do patrolling and it may be hazardous, and you don't want to risk the life of someone, this can do patrolling in a dumb manner or in an intelligent manner. And it can also be connected by link to a drone, which will give an overhead picture, and that drone and this together can work to find someone and triangulate and pin them down, you know, incapacitate them, or do whatever else is needed.
So if you take the clock back and if one looks at the construct of Bharat Forge, there was a time it was 100% automotive. Then came the engineering and industrial business, and now it's defense, it's EV and large industrial world, if I may use so. So Bharat Forge of 2025 and 2028 and 2023, how will the migration change?
So Bharat Forge of 23, you know, defense was still a business that was going from incubation into production. EV is still being incubated, aerospace is still being incubated, Industrial is growing and we've added a bolt-on acquisition. In 25, defense will have reached some amount of maturity. We'll
It
see.
will be profit making for you?
Oh, absolutely. Defense will be profitable this year.
Okay.
And I would say very profitable.
Okay.
So it will not be dilutive to our profits.
Okay.
EV will, aerospace is also growing. Aerospace has grown almost 100% all over last year to this year. It will continue to grow. We have a large pipeline, also very profitable. EV by 25 will become, go from incubation to revenue and should be profitable. By 28, I think defense will have matured. It will have become a serious business with 2 or 3 verticals within it. And each one with its own growth opportunities and global growth opportunities. I mean, if you look at a defense business today, we have an order book of over 2,000 crores and that's all exports.
So all the vehicles are meant for exports?
No, this is still a proto stage.
Okay.
What we have in the other plant are what we are already exporting, which are our guns and our mounted guns and vehicles. Then aerospace will be a high growth business. EV will have matured, and by 2030 I think all these will have matured and will be in a stage where there will be a platform business. That a platform business then becomes a business which can start growing on its own, even start doing M&A of its own, or consolidation within India of its own, and further products and geographies, etc.
So then the geographical breakup, what markets obsess with every month, Class A truck ka sales ka number kitna hai? That's a number which we look at.
But honestly, Class 8 as a percentage of our revenue is less than 15%.
And if the migration to EV, defense and aerospace continues, by 2027-28 will be less than 10%.
The same products will become far less than 10%.
Okay. One number which markets and shareholders always look at is ROS.
Yeah.
Your ROS has fluctuated in last couple of years. Is that largely because of investments?
It is because of investments. And please understand, it took 12 years for us to incubate our defense business. It will take less than that for our EV business. It has taken less than that for industrial. Our overseas businesses have taken longer because nobody could anticipate COVID and what it has done. But our ROC targets are well in excess of 20%. And I'm confident that by 2025 we will be well in excess of 20%. 22-23% or so.
So does that also means that you're assuming your global business will come back? It has to normalize.
It will come back. Of course it will come back. Our European business will be profitable this year, and our US business will head towards profitability by the end of this year, and by next year that also should be profitable.
So what Bharat Forge has achieved in last 5 years, you're likely to achieve that in next 2 years?
Oh, I hope so.
Because for you, all your businesses now are filing full cylinders, you're ready, CapEx is done, and now it's really operating.
CapEx is done, but we also need to do more CapEx, as we announced on our results call.
Yes.
We'll invest slightly over 1,000 crores in the next 24 months or so, in both our conventional business, in EV, in aerospace, and in industrial.
What are you doing to increase the moat around your business? Good companies always focus on that. How can they make the company more distinctive?
So we are increasing our moat by doing 3 things. One is, in our existing business, we will become the last man standing, which means the highest quality, the highest capability of engineering, most competitive cost-wise, and unmatched financial strength. In new areas, we will be lean, mean and hungry, and we will use technology to drive our business, and we will continuously reduce cost, and we will use technology to reduce cost. And we have an amazing technology platform that we have in place now, which is going to help us increase our productivity quite dramatically while reducing cost. So that is what we will do to increase our moat. And the last thing you have to do to increase your moat is increase your customer affinity or your customer relationship. And that has to be through engagement, bringing value to your customer, and that is something we do through technology, and that's what we do in this building and the next building.
The fact that you are increasing into and spreading yourself into new areas, that means more customer interaction,
yes,
more deep understanding of supply chain,
yes,
more and more agility to adapt,
yes,
and more reliability of the customer on your business.
Yes.
there are too many wheels within wheels.
Yes.
I know you're in the wheels business. You have to keep on managing the mechanics there. But this is business strategy which has to change optically and very strongly for you.
Yes, so we have clearly, recognized this and brought in a lot of high quality management at the vertical level to look after each one of these aspects, because you can't run it as one monolithic business. You have to run them as 5 separate businesses reporting into one, and also using fungible assets within each other.
Will Bharat Forge eventually be a holding company where some of the subsidiaries could list?
I mean, I would never call it a holding company, but Bharat Forge will be a company that will create a lot of new companies within it.
But for the Kalyani group, there are some companies which are listed outside Bharat Forge.
Yes.
The fact that you're focusing right now on the engineering prowess, and those are small subsidiaries and small businesses for you, does it make commercial sense for you to list them? Or even regulatory sense for you to continue to list them?
Like a steel business?
Yes.
It's historically been listed, it's 50 years old. In our country, things that happen once become very difficult to undo.
One AGM every year, a couple of board meetings every year, more paperwork for you.
That's okay.
Not
But
the
they're good
focus area for
businesses.
you.
But they're good businesses. And those businesses will also grow. We will also grow those businesses to keep. Please understand, those businesses are a very big strength to us.
Okay.
Because we would not be exporting as much product if we didn't have the quality of steel that we do, which we get because of having our own steel companies. And not just our own, many other companies buy our steel and export also.
Okay.
Because our steel that we have to use is approved by our global customers. So once it's approved by one global customer, there are many other consumers who consume it
The
also.
backward integration. for you.
Absolutely. And that's a big advantage.
So I'll divide my couple of last questions into pockets.
Okay.
Short term, medium term and long term.
Yeah.
For Bharat Forge, for short term, when I say short term, 1 to 3 years, that's a short term for an entrepreneur. 3 to 5 is medium term and 5 year plus is vision. So for the short term, what is the opportunity? What is the challenge?
For the short term, very clearly is turn around our global businesses, grow them, maximize the growth of our defense business, grow our acquired industrial businesses, continue growing our aerospace business with whatever capexes we already have done, and continue growing our component business. Okay, that should give us a 15% plus CAGR. That is what we expect. Sometimes it will be higher, sometimes it will be lower, but that's what we expect. Then for the 3 to 5 year, build the defense business into a whole meaningful business. A meaningful business means, going from 1,000 crores to 4,000-5,000 crores. Industrial from, 2,500 to again 4,000-5,000 crores. Aerospace, hopefully take it to a 100 million plus business. And, also EV to couple of 100 million, if not more. So that's the way we look at the 5-year horizon.
So
EV, in my opinion, could even be bigger than that.
So if I say what happens in the market in the short term is a function of price discovery, but for an entrepreneur, for Bharat Forge, अच्छे दिन नहीं बहुत अच्छे दिन आने वाले हैं.
Yeah, I think अच्छे दिन ही आने वाले हैं, because see, we have no, either as a company or as promoters, we don't have any stress. Okay, the company is not loaded with debt. We have a lot of opportunity. We have great people. I think our biggest strength, more than anything else, is the phenomenal people we have in every part of our business. Right from the shop floor to the engineering to sales and marketing, everyone. They're very passionate about what we do. And to harness that passion and to get the most out of that passion is really what is the job of management.
What is a day like in Amit Kalyani's life? What time does he get up? What time does he sleep?
Oh, I should be waking up earlier, but I probably wake up around 7. I sleep probably close to midnight. I read in the night. I read a lot of stuff online. I try to follow what's happening in technology and trends, and I follow a lot of these technology channels, so I try to keep up with that.
How do you keep yourself up? Because technology is so dynamic, changes. It really changes.
What I understand, I understand. What I don't understand, I don't understand. But I know that I don't understand. So I have a good tutor at home, my son, or my daughters, who bring me up to speed. And then, of course, we have our CTO, CIO, who all bring us up to speed on this as well.
Final question. If there is a billboard which has just one mantra which you believe in, what would that billboard be? And what would that mantra on the billboard be?
I have one poster in my room that says, "What if everyone's wrong and you're right?"
Do you really apply that?
I believe in that. That don't follow the herd.
That helped you during COVID?
Definitely. And this is a lesson I learned from my father. That don't follow the herd. But everybody follows what is easy to do.
Yes.
What is difficult to do is what makes you successful. Developing technology on your own. Spending 12 years in developing your own products. When nobody gave you a chance. That is what makes you different. That is what makes you unique. That is what makes you a champion.
All right, taking a look at the screen then, and at 19,380, it is a decisive flattish move with a negative bias. It's energy as well as consumption. Those are some of the sectors, along with FMCG actually, that's looking a bit weak. And the banks actually are doing precious little yet again in today's trading session. And the narrative, Nikunj, continues to remain the same, that it's the broader markets, they're taking leadership. We're absolutely flatlining when it comes to the frontliners, and banks not doing much.
You know, you are in that phase of the market that you're really better off doing nothing. You know, just do nothing. You don't have to have a compulsive view in the Nifty. You know, you're not playing a T20 match that there are 20 overs and there are 120 balls and you have to get it right. Even in trading, you don't have to be a compulsive trader, and that is Nifty for you. First, if there is no trend, there is no point in trading in a trendless market. There is a line which I read somewhere, which is that never short a dull market. So you don't go short, you don't go long. Then what do you do? Well, enjoy watching ET now. The lovely interviews. Countdown to Chandrayaan. There are lovely videos we have. We've gone to Pune. We've come back the whole thing of, you know, what this lovely city of Pune is. I think we are going to that phase of the market where compulsion may actually force you to make an error. And when you make an error, you lose money. I'm not saying that there are no bargains or no trades in the market, but purely from a Nifty standpoint, just think about it. It was like a flat line yesterday, and it's a 19,000 index where the change is only 15 points. Now, how do you trade? So, just take it easy.
Yeah, you don't have to trade every move, right? So, stand pat. Coforge, MFSL, BHEL, by the way, after that 10% move yesterday, today it's taking it easy. It's down about 2% or so. Sun Pharma, Balrampur, Chini, some of the other laggards in trade right now. I just want to check in on what the breadth of the market as well is indicating, because you know, you're not really seeing a huge move there. I mean, it is a count in favor of the declines for sure, but it's not like it's a very big margin or a gaping hole in that sense. There's Crompton, which is holding up very smartly, 5.6% higher as we speak right now. That stock is looking very, very good. There's, of course, some of the other names which are also right now in focus. Chambal Fertilizers has made a very smart move. Colgate Palmolive after the analyst meet yesterday, that's holding up 3%. Indiabulls Housing, Hindalco, 2.5% higher on both these names. And that's the other thing, right? Because in this lull of a market, Nikunj, there's not one sectoral trend either. It's all about individual stock names.
Yeah, I mean, you just think about it. Now look at banking. IDFC Bank has done well, Kotak Mahindra Bank has done nothing. Within banks, within smaller banks, well, you got a situation where EU has done well, but Federal has not done anything. So yeah, these are trends which are within trends. You got an all railways, that's a large theme. You got an odd action happening in defense, but that's like not the most powerful theme. The market right now are, I won't use the word struggling, but I think they're simply marking some time. The bulls are, just waiting for the next trigger, which frankly is not there in the system which is not there in the system right now. But could it be tomato prices? Could it be wheat prices coming down? Or could it be both? Now that's the story what we need to understand from the management of Vector Foods. Manu Talwar, Chief Executive Officer of Vector Food, joins us. Now let's understand from him that how high tomato prices, wheat prices, corn prices, main prices, oil prices have changed business for them. Good morning. Thank you for joining us. So every morning, do you open your phone looking at tomato prices, onion prices, oil prices, wheat prices? Is that what is keeping everybody busy in the hospitality industry and the food industry?
No, definitely the prices has been going up and down, but they are maintaining their calmness. There is some bit of stability compared to last year, definitely there, and which is fine for the food industry as of now.
You see such a big spike in inflation, and it really could be transient also in nature, but such a large spike in inflation which will have a challenge both in terms of supply, availability and margins. How do you deal with it?
In terms of supply side as of now, and the inflation, the consumer inflation which is there, these are the challenges, if you look at, have not clearly settled down over the last 15 months. They have certainly come down, right? They're certainly better than what we were in the last financial year, right? So this is, as an industry and as a company, we have kind of learned to manage and kind of live with that while we work on growing our revenues and volumes and also managing our margins.
Okay. So walk us through what will happen because of high wheat prices for the current quarter and coming 2 quarters. How will you manage your margins?
No, as I said that some bit of volatility we have factored in terms of making sure the margins which we are targeting, we are able to deliver over the next 2-3 quarters. But of course, if we see a larger volatility, that will be impacting. But as of now, over the next 2 quarters, we are good to manage our margins. As of now, the trends what look like.
Right. Mr. Talwar, in the eventuality that wheat prices and some of the other key commodities that you consume in your business don't come off, would you then have to pass on these hikes on to consumers? And are we looking at significant price hikes in the days to come?
Not as of now.
Okay.
I don't think we've reached that stage where we have to look at price increases, right? As of now, we good for the prices, and especially on the biscuit side where we are much lower grade, we always keep a look at the large players, large industry players who are the industry leaders, where the industry is trending, right? But as of now, we see clearly it's a growth which is going to be led by distribution and the volumes over the next 2-3 quarters, unless until the things change quite dramatically, like it happened in the about 4 to 5 quarters back.
Right. Good morning then, Mr. Talwar. I wanted to also understand from you what the outlook is when it comes to the bakery segment, because that's about 35% of your total revenue pie. How do you see that segment growing, and what exactly are going to be some of the levers for growth for the bakery segment?
In case of a bakery segment, I think that lever for growth is primarily the expansion. Bakery is a segment which is a very well growing segment, right? The penetration in the segment is growing month after month, And with the kind of product lines we have, the only way forward is to, expand our distribution, service it well, and make it reach to the more consumers, duly supported by the brand marketing.
If your product is in B2B as percentage of your total revenue, where you would be forced to honor the fixed price contracts, and in a sense the price escalations will not be at play and they will only be renegotiated next time.
Yes. So in case of a B2B business, we normally, kind of take care of our buying and commodity for the year, right? So we kind of good for that period. So we don't see a challenge on B2B side.
And as percentage of total sales, how much is that for you, sir?
Pardon?
As percentage of total sales, how much is B2B for you?
It's about 11% odd.
Okay, that's not much, 11% and where you hedged completely. So anybody who's got this huge concern, and especially when I speak to folks on the street, they are of the view that commodity producers are in for a tough time. I think that's a myth. That's not the reality then.
No, so again, what I'm saying that unless until trends see huge amount of, adverse change, we see it should be good for next, 2-3 quarters. So it's all about, that commodity trends remain calm, don't have too much of volatility. It should be good, but unless until we see huge amount of volatility, then things could be different.
So I'm sounding repetitive with this one, but you'll appreciate the spirit of my question. I just don't want to get this one wrong. So Mr. Talwar, what you are sharing with our viewers is that right now, even though commodity prices are high, it is something you can manage. It is not a stress. It is not an alarming situation for you.
It's not as alarming as it was last year, in the beginning of last financial year and the end of the previous financial year. So it's not, I'm sure industry players would agree that we are not in that stage as of now. But we do expect that supply chain should remain well in place and there should not be huge amount of volatility.
Since a lot of crop will start coming in and around Diwali and Dussehra, especially for cereal, what is your understanding how the sowing is moving? When you speak to your farmers, when you speak to some of your partners, are you getting a sense that, like tomato prices have come down after the new crop has come down, even grain prices and wheat prices will start coming down?
To be honest, I don't think we have too much of, kind of analysis and knowledge on that as of now. So what's going to be a future trend down 3 months or 4 months from now? So it'll be tough for me to comment on this.
When I speak to your peers, there are two trends which are visible. Trend number one is that the luxury or premium FMCG food categories are doing exceptionally well. But there is a stress on the rural end and there is a stress on basic entry-level food categories. Is that something which is prevalent for you also? If yes, why? And do you see that changing?
So definitely, you see, we are at a stage as a company, right, where our prime amount of growth is being led by distribution expansion, right? So we are very aggressively growing our distribution, duly supported by marketing, brand marketing, right, which is the lever of growth for our company, right? So that's good for us as of now. In terms of coming the trends on the premium side, yes, definitely the premium segment, especially in the biscuit side, we are noticing is growing better than the mass and value segment. And as a company, we are a company which are primarily in the value and the premium category. We are not so much in the mass category.
Talwar, great to have you today on ET Now. Thank you so much for taking the time out and giving us perspective on how this high agri-commodity inflation is actually impacting business such as yours.
Right. Thank you very much.
Okay, let's move on and let's talk about one of the new listings, Concord Biotech. It's the first interview that they're having post their listing. So let me welcome on board Ankur Vaid, the Joint MD and CEO at Concord, joining in on the show right now. Ankur, hi, morning. Great to have you today on ET Now. Now that your listing is done, let's talk about numbers and tell us what the company sees by way of revenue as well as PAT growing for FY24 and even beyond.
Sure. Good morning, everyone. So, just to give you a brief before we jump into the numbers, we have recently set up in FY22 one of the largest fermentation plants, wherein we have put in 800 meter cube of capacity vis-a-vis the 450 that we have at Unit 1. And this has been primarily put considering the expansion of the existing products and commercialization of the R&D products, which we have quite a strong range of products, large range of products in the R&D segment, particularly in immunosuppressants, anti-infectives, oncology, and antifungals. So considering that, we are expecting to have better revenue compared to the CAGR growth of 18% that we have had over the previous 3 to 4 years. So we expect to do better than what we have done historically, which was a CAGR growth of 18%. And this, as economies of scale would kick in once a new site starts ramping up, we see our margin profiling being better than what it has been historically, which has been in the range of around 40% EBITDA.
So, fair point. Thank you for that. And, this is the second question which I just wanted to come to. Your EBITDA margin are at 40% and return on capital, ROE and ROC are in the range of 19 to 20%. So do you see a marked improvement even in your return ratios? Because if you're looking at adding capacity, operating leverage benefits would kick in?
Yes, so that's correct. That going forward, since we have enough capacities now in place, we do not see any significant capex coming in, and we would now be focusing on optimally utilizing the infrastructure that we have created. This, as you rightly said, would help improve the EBITDA margins as well as the return on capital as well.
Okay. The entire pharma supply chain is a very complex supply chain, and there are wheels within wheels. But you are, in a sense, right at the entrance, which is that you give base fermentation products which are required for the pharmaceutical industry. So are you also exposed to the volatility within the pharma sector in terms of pricing, or yours is more like a B2B product, it is going to be constant and will go irrespective of the big large trend?
No, so of course, we are part of the larger universe of pharma, of course. So any changes does impact us. However, I'll say that we are not impacted unlike the chemical companies because, in fermentation, our raw materials are the basic raw materials which are more agro in base, like the corn, dextrose, maltose, and all, which are readily available in India. So our dependency on China is not there. So we are not, the raw material doesn't impact us. Maybe, of course, if there are macro changes which impact, say, things like solvents and other things, which would definitely be impacting us. But not on the raw material side. Of course, on the pricing side, we always try to be more aggressive so that our customers can gain much larger market share, and that is one of the reasons that why Concord, for many of its products, have a global leadership position, which is basically a function of how our formulation partners have gained the market share. So we kind of support our customers on the pricing there.
Ankur, when you look ahead, besides the top 5 products in your portfolio, tell me the newer therapies that you're looking at venturing into. I mean, would you, for instance, enter hormones or, the steroids category?
So, fermentation, again, is a very large segment. And while we are there in these four therapeutic class of products, which is oncology, immunosuppressants, anti-infectives, and antifungal, we are not limited by the therapy. I think as long as it meets the certain criteria that we have built internally, we are open to explore those newer set of APIs even if they are in different therapeutic classes. But our expertise in fermentation gives us the advantage to move into other segments such as the steroids, peptides, enzymes, and others. However, for such kind of projects, you need to have a separate facility. Like for steroids, you need to have a separate manufacturing block. You cannot do it in the same facility as the other generic fermentation APIs. So that is definitely something for potential growth opportunities that we could consider going forward.
Why have you stayed away from the US markets in a very large manner? Because if I look at the list of countries where you're present, Nepal, Mexico, Indonesia, Thailand, Ecuador, Kenya, Singapore, and then US. Is my understanding right that you've consciously stayed away from US market and you're going there now?
No, so I think US is one of our very key markets that we operate in. And when we talk about that, that we have a global leadership position on many of our APIs, US being a very key market, of course, our presence is quite strong there in the US. And I would say that we work with all the major companies in the US, companies which are there in the US, and Indian companies who are selling their finished products to the US. So in the API segment, I would say that we have a very, very strong presence in the US market, and this would be one of our very key markets actually to go with.
Walk us through about the government and the institutional business side of yours. That's also a very large business, and since you have a very formidable presence of 1,500-1,600 associations, what's happening there? What is the uniqueness of this business?
So, our government and institutional business, we are present in the India market through our branded generics, wherein we have presence in the nephrology segment as well as in the critical care segment. And, Concord, I would say, is one of the only players which is in the immunosuppressant segment, which is getting the API and the finished product from the US FDA side with all the B studies and catering to India market. So we are serving the transplant patients with the highest quality of products that we sell to the global markets. And this is whether be it the corporate hospitals or the government institutions. And this is one of the reasons that because we have such high quality products to the India market as well, our business in the India market is also growing in the corporate as well as in the government sector.
Okay. You have very famous investors in your company, and Rare Enterprises, very famous investors have invested in your company. Have any of the key investors who invested in your company a decade ago, 10 years ago, have they taken exit in the IPO?
No. So they continue to be with us, and I believe that they understand and they have faith in the growth potential that Concord has, especially now that we have created such infrastructure. So we are very hopeful that going forward they will continue to be part of this journey with us.
With a very powerful remark that your historical growth rate is 18%, and after the capacity addition you expect it to grow higher than the historical growth rate. What will be that higher historical growth rate, both in terms of margins and also in terms of CAGR top line?
So I may not be able to give you numbers there, but I would say that yes, as the facility, so we expect to do better than the 18%, and as facility keeps ramping up, with 450 meter cube at one point of time, we were doing close to around 700 to 800 crores of business. So now that we have put up the 800 meter cube, there is a significant amount of growth that we look over the coming 5 to 6 years. And this is a function of how the facilities will start ramping up.
Okay, thank you for walking us through the outlook on your overall business plan and how things are shaping up. So yes, they are looking at US as a very key market, very aggressive strategy when it comes to pricing, saying that as of now, the dependence on China is negligible, capex is not significant. 991, that's Concord Biotech. Just let's quickly check in, by the way, on TVS Supply Chain. It made a pretty tempered debut on D Street just earlier today, a short while ago. Do remember, on account of the fact that it's a pretty competitive industry, there's aggressive IPO pricing and the kind of financials that don't really add up, given the hefty losses, it's not too surprising. So 200, that's where it's currently at. Tell you what, we'll take a very short break right here on the show. Be right back for lots more.